actual definition is that 10-year period around your retirement date. Even now, historically, so we've been talking about this for a while, but now, think about the time of history now, and the proximity you are to retirement. So your age, the situation in America, we talked about it when we tore up the dollar. We've just had 40-year record high inflation, 40-year record high inflation, 2 years in a row. We've had record market volatility. In fact, the market volatility during the COVID year, 2020, when it went down and then back up, both of those were records. We've never seen that kind of volatility. But even if you throw that out, that was considered a black swan event. But, there was such a weird reason for that. If you throw that out, we have still seen record volatility. And so, as you think about the proximity you are, what's going on nationally and internationally, and why we call it the red zone, because you really have to make good decisions. And so that's why tonight we're going to talk about one aspect of income planning. And we help folks with all of these or any of these. And so part of your attendance tonight is a follow-up session if you would like one. It's up to you. So you're going to learn a lot tonight, but you might want to know how some of the concepts we talk about apply to you very specifically. So we're independent advisors. We do custom planning for families. And so if you do want that, then you can let us know. We do ask that you go ahead and fill out the blue sheet because we have to actually turn that in. Also, so fill out the blue sheet to give us let us know you attended. Also, you can give us feedback on how we did so we can improve future events. And then also, if you would like to be on the newsletter, you can let us know. But if you do want that follow-up strategy session, you can let us know on the blue sheet. We'll take a break about halfway in because with larger groups like this, we do kind of get a bottleneck at the very end. So Melissa, though, can get you on our calendar if you want to just let her know maybe at halftime. We'll give us about a 5-minute break and you can go ahead and turn your sheet in then. So let me jump right into the Social Security because I know that's why you came to learn about that. And Karen, you probably, or you may be aware that events like this, there's a lot of content that may be covered. And so it'll cause you to think of questions. But just know we've anticipated a lot of those. So we're going to cover a lot of the questions that you might ask during the course of the event. So Diane, if you can just kind of be patient with us and let us get through it. At the end, if we haven't answered your question, probably the best thing, if it's real specific to your situation, rather than share your personal information with the group, maybe just ask in the strategy session. We're totally fine if you just want to schedule a phone call also to get your question answered. So with that in mind, let's jump right in. Here's a question on the slide. Generally speaking, in life, would you rather be early or delayed? Early? Okay. Early? Delayed? No?
I don't know.
You're not sure?
Yeah.
In life?
Tell me the benefits to be earlier than the penalty.
Okay, good. He wants more info. I like that. And your name's Roy. Would you rather pay a penalty or get a bonus? Bonus. Okay. So has everybody bought their lottery ticket? We know it's at $1 billion now. Okay. So one thing I do require if you win it, that you let me handle that for you.
Yeah.
$1 billion. So if you win it, just remember these words. Blind trust. Get a blind trust. That's what you need if you win the lottery. So we do legacy planning. All right, so let's remember this slide because we're going to come back to it at the end. So the title of this is what baby boomers need to know about their retirement income. And so people are hurting their retirements by making costly decisions on their Social Security. They're leaving dollars on the table a lot of times. So you need to know with Social Security, there's a lot of different claiming options. Hundreds, in fact, really that represent, and you've got two from 62 to 70. So that equates to hundreds of different combinations of filing options that you have. the decision you make on your filing for your retirement benefit with Social Security has far-reaching implications, and it does affect both spouses. So many times we'll look, so my job when you come into the office for a one-on-one strategy session is to give you all the information that you need to make and really a good decision. And I'm going to base my information on math and science, and you'll be able to look at that and see how it affects you. But there's something else that comes into it, because sometimes people make a decision based on wanting to protect and to have a more secure life for their spouse if they're not around. And so that's a whole other set of circumstances, or it brings emotion into the decision. And so that's okay. We want to recognize that as valid, because we are emotional creatures, and so we want to know the math and science, and we want to understand what our options are, but we also want to know, well, what happens if I do the best thing to maximize our benefits for math and science, but not for my spouse. So we want to know both of those. So the system's not bankrupt, and it's not a Ponzi scheme. On my website, I interviewed Dr. Larry Kotlikoff. He's been named by Economist magazine as one of the top economists in the world, one of the top 15 economists in the world. And he's a professor at Boston University. He's an endowed economics professor. I would recommend everybody just watch that. And the purpose was, I do a lot of these events, specifically on Social Security, and he's an expert on everything fiscal. So whether it's Social Security, tax code, or Medicare, the insurance portion, and even the healthcare marketplace, he's a fiscal expert on all of this. Right. And so his opinions are, to me, very interesting. I don't necessarily agree with everything that he says, but we asked a lot of really poignant questions, and one of the big things I got from it was the system's not going to go away. It cannot go away because so many Americans depend on it. We're going to show you in a minute what percent of income Social Security represents, but what I want you to hear is it represents 100% of income for over half of Americans who are retired. Over half of Americans, 100% of their income. They don't have any other source of income.
What was that gentleman's name?
Larry Kotlikoff. If you look it up, it might be Lawrence, but he goes by Larry. I called him Lawrence about 3 times, and then he corrected me.
Yeah.
You probably know family members that benefits have helped. You may already be receiving Social Security benefits, so you're aware that the system is alive and well, and your friends are not experts on this. I'm a National Social Security registered advisor. The nearest one that I know of to here is in Little Rock. So I do consider myself an expert on this topic, and we've helped hundreds of families make their Social Security filing decision. So will it be there for me? How much can I expect to receive? When should I apply for Social Security? How can I maximize your benefits? And will the benefit be enough to live on retirement? So those are just some of the questions we're going to address tonight. So what is the value of your Social Security income? I just flipped right to the next slide. I didn't do that.
It doesn't like that slide.
All right. So will it be there for me? In 2021, the trust fund balance went from $2.9 trillion on December 31st the previous year, and they paid out $1.14 trillion. They brought in $1.08 trillion, and so the trust fund decreased by $56 billion. So the balance 1 year from 12/31/20 was 2.852, about $56 billion less than the previous year. So you see they're big numbers, but there's still a lot of money in the trust fund. Most experts say that the trust fund will be depleted by 2034, 35. Dr. Kotlikoff believes that a payroll tax increase of 4% would take care of all that. What Congress is currently proposing is about a 25% reduction of benefits. So if you came into the office to model your situation and look at a cash flow plan, an income plan, we can do that. We can show, well, here's what it would be without the reduction and with COLA, with cost of living adjustments added. And then here's what it would be if in 2035 they reduce the benefit by 25%. I actually recommend that you do it that way, because if you put pressure on your situation and you look at worst case scenario and you're still okay to retire, then you're going to feel pretty good about that if it works under pressure. So we're going to put a lot of stresses on your income plan if you want us to do that for you. I think that's enough. Benefits fall to 80% of current levels in 2035. I've seen 75%. I've seen anywhere from 70% to 80%. So it's probably going to be somewhere in there if they don't make changes prior to that. So what would it require? They could increase the maximum earnings subject to Social Security tax. They've already done that. And if you'll, and that actually, the maximum earnings of Social Security actually go up every year. So they're already doing that systematically. In your packet, there's a tax guide. I use that every day in my office, and it shows this year what the maximum earnings is on Social Security. So you can see on the front page in the middle column where it says Social Security, the maximum earnings this year is $160,200 subject to Social Security tax. That went up from last year. It'll go up again next year. And so if they could accelerate that amount of income that is subject to Social Security tax. It's a good and bad. It's good because if the higher income that you're paying tax on, the higher your future benefit's going to be. It's bad because you pay taxes on more of your income, and really most people believe if they could invest the money, they would do better than if the government took it as a Social Security tax. Social Security offers you an income that you cannot outlive. So if your benefit is $2,000 a day, your lifetime benefits, if you made it 10 years, would be over $250,000. Over $600,000 if you made it 20 years, and over $1 million if you made it 30 years. There's cost of living adjustments. We call those COLA. And so if your benefit's $2,000 and the COLA is 2%, by the way, the last 2 years combined, it's been 15% total. Over 6 in 2021, over 8 in 2022. So your 2,000 benefit, though, in 10 years with 2% COLA would be $2,438. In 20 years, it'd be almost $3,000, and then in 30 years, it'd be over $3,600. I don't know what's going on with this. So the bottom line is Social Security is inflation-protected income. You've paid the premium out of every paycheck, and so we want to be smart on how we collect it. So at age 62, each year's earnings are tallied and indexed for inflation. So they're going to take the highest 35 years of earnings, they call that AIME, A-I-M-E, and they're going to index it, and then they're going to apply a factor to it, or a number, and then that'll determine what your benefit's going to be. I'm not going to get into all the bin points and all that. It's a little technical, but basically what you need to know is they're going to take your highest 35 years of earnings, index it for inflation to determine your benefit. What if you don't have 35 years of earnings? What gets averaged in? Zeros. Right. Your minimum work that you need to work to qualify for a benefit is 40 quarters. which could be 10 years, but it doesn't have to be consecutive. So it's just 40 quarters. So if you work and pay at least a minimum amount of earnings in each quarter to qualify for a quarter, then you're going to qualify for a retirement benefit. And by the way, that also qualifies you for Medicare Part A without a premium. So currently there is no premium for Medicare Part A. If you claim early, your benefit's going to be reduced. And it could also be reduced for taxes, and it could also add to your Medicare premiums. Benefits could be withheld if you work, and that's called IRMAA. I don't know what the heck is going on with this. It keeps bouncing. Okay, we did that. Okay. So will Social Security be enough to live through retirement? Probably not. Probably not. So you'll need to supplement with, for most people, you'll need to supplement with other sources of income, whether it's dividends from investments or distributions from investments, rental income. You know, you worked hard a lot of years to build accounts. So we have some families, though, that when you combine their benefits, it does meet all of their income needs. So the highest benefit is somewhere around $4,000. So if you have two spouses, and we have a few clients that both of them throughout their careers, they pay taxes on the maximum amount of earnings, and so their benefit's the maximum. You remember on the earlier slide it said at 62 is when they calculate, and so after 62 there's not COLA reported on your Social Security statement. So if you print it off or you go to Social Security SSA.gov and look at your benefit or your statement, it's not going to reflect COLA, cost of living adjustment, past 62. So our software will do that, and we can look at what your potential future benefits are. Because those are the decisions you need to, those are the examples you need to see. Those are the what ifs that you need to model to figure out when the optimal filing age is for individual or for a combination of both spouses.
And that part of that jumped from like, it said from 1954, it's so much, and then it skips and it says from 1960. So what about people who are in between 54 and 60? I think that's what it's the numbers.
Yeah, I'm going to show
The year
you.
you were born.
Yeah, that's a great question. All right.
Are those people just kind of floating out there?
Now that was 2 cents. You just gave me your 2 cents.
Yeah.
So I love good participation and good questions. So I'm gonna give you a good return on your 2 cents. Okay.
No.
Thanks, sir.
All right. So what return is that, by the way?
That's 2%.
2,000.
2,000. Well, 2
But I don't know
cents
what
to
he get.
$2.
Was that, oh, that was a $2
$2 bill.
4,000?
100%. Or 1,000%. It's 1,000%. Yeah. So 10 times that. Oh, that'd be 20 cents. It's 10,000. 20 cents would be 10 times. But 1,000%. Okay, yeah, that's right. I'm a financial advisor. We're in trouble, aren't we? All right, so.
Get your calculator.
Yeah. Get the calculator. As Jethro Bodine would say, learn your gazintas. All right, so. All right, I just restarted it, so we'll get to where we were here. Shouldn't I claim at 62? Here, this is a common question we get. Shouldn't I get mine while the getting's good? Shouldn't I go ahead and get it at 62? Because the system's going away. You know, my brother-in-law told me, you know, I better get it now. So it's erroneous thinking, okay? The reason people file early as possible at 62 is they can't work and they don't have anything else to fall back on. They have to take that income. When you compare the early filing, and especially if you're still working and you file before your full retirement age, you're going to have a benefit reduction, most likely the full amount of your benefit. So again, on your tax guide, it shows that.
Do you have an extra copy of one of those? We didn't get one in our package.
You didn't? Let me find where it's at.
You don't actually
It's in-
lose it, but you get it later.
You get it back. It comes back, but you get reduced, and you're
You
going
get
to.
reduced now, but you get that same amount of money.
That's correct.
Back when you reach your full retirement.
That's correct, but you're going to lose out on your delayed credits.
Explain.
All right, between 62 and full retirement age.
Oh, what, it would have gone up?
Yeah, it goes up about 6% a year.
Okay.
From
I understand.
full retirement age to 70, it goes up about 8% a year. And then those amounts plus cost of living adjustment. So on your tax guide, it's in the middle column, and it's small print below the income in retirement causing Social Security to be taxable. So under that, you can see the thresholds where your income, IRMA, income adjustment for working while you're before full retirement age, how much your benefit will be reduced. It's a very low threshold so for a lot of people, you're going to have a full reduction of benefit. And what you just did is, although you're right, what was your name? Don. Don's right. You do get it back at full retirement age, but you lose out on all the delayed credits. Okay, so you're still going to be stuck with the early filing amount without the delayed credit. So think about someone. Another scenario would be someone that's reached full retirement age and they're delaying their benefit to 70. So remember, I said you get 8% COLA or delayed credits a year. You also get COLA. So think about the last 2 years. Someone that was delaying their benefit the last 2 years who had already reached full retirement age, 15% COLA plus 16% delayed credits, their benefit would be 31% higher than it was 2 years prior. That's a significant increase. So your benefits reduced if you claim early. It's also reduced through taxes, Medicare premiums. We already said that. Now we're jumping again, aren't we? So when you decide to apply, you're going to look at these factors. What's your health status? Remember what we said a minute ago? If you're in poor health, you can't work, and it's your only source, then that's going to be a factor. Your life expectancy. How many in here plan to live to 79? Anyone? A few, no, not you. You're not going to make it. You are. How many don't raise your hand for anything? Raise your hand.
Raise your hand.
So that's the break even, by the way. Age 79, when you apply a rate of return to the early filing amount to make it a fair apples to apples comparison, a reasonable rate of return to the early filing amount, age 79 is a break even. So if you wait at age 70, which is the latest you'd ever want to wait to file for your benefit, starting at age 79, you're ahead of the game. You're playing on the government's money, in other words. So when I really thought about that statement, I thought about why do people file early again? Because they need the money. So in reality, although it's a fair comparison because we're showing a rate of return on the early filing amount, no one ever invests it. Everyone always spends it, right? So in reality, the longer you can wait, the better off that you are in most cases. Okay. So I think this answers that previous question. Peter, are you the one that asked that?
Yeah.
So between 1943 and 1954, the full retirement age was 65. I'm sorry. Yes, it was
66.
prior to 1943. So 1942 or before, it was 65 if your birth year was that. So your full retirement age is 65. So that was the only full retirement age for a long time. And then they added this scale, these factors. So for a lot of people in the room, your full retirement age is 66. And then for every year between 1954 and 1960, your full retirement age goes up by 2 months. And then 1960 or later, your full retirement age is 67. So if you were born in 60 or later, your retirement age, 67. My full retirement age, 67. And a lot of folks, your full retirement age is 67. That's the year, that's the age at which you will not have a reduced benefit. If you file for benefits prior to that, it's reduced approximately 6% a year. And you can see some years it's 5, some years it's 6.7, some years but on average it's about 6% a year. So you receive 70% of your benefit at age 62, 80% of your benefit at 64, and then 100% at 67, if that's your full retirement age. And then between full retirement age and the latest filing age of 70, again we said an 8% difference. So it's simple interest. So it's just 8%, 16%, 24%, 32%. So depending on when your full retirement age is.
What's PIA and FRA?
Primary insurance amount. That's the amount you would receive. So good question. And what was your name?
Lori.
Lori's question was, what's PIA? And it stands for primary insurance amount. That's the amount that you would receive at your full retirement age. Hey, throw something at me if I miss you, because I know.
Yeah, I drove.
You drove?
I paid for dinner.
She paid for dinner. All right. So we recommend everyone go to Social Security's website, establish your login. Your information's already there, whether you access it or not. So go ahead and establish a login where you can see it. It's updated daily. So you can see a statement or Social Security statements daily. If you would like a strategy session with us, print it out and bring it in. We like to, well, that's one of the things we're going to help you with. We'll plug it into 2 different softwares to really crunch all the numbers for you. Okay? So it's ssa.gov. So how can I maximize my benefits? You can improve your earnings record. I've had more than one family that have come in for a one-on-one session that have done what this says, and they were able to improve without working anymore. And so what they did was they just checked their statement. And that's why we encourage you to log in and look at your statement, compare it against what you thought you earned. And if it's wrong, you can have it corrected. So everyone saves your tax return for 30 years, right? So there's some limited amount of years we can do it. You do. You're actually one that does it. Okay. So you want to see if it's accurate. Are there missing years on there? And you could also work longer. We've had multiple people that have come in and they were 6 months away from qualifying for a benefit. So they had only had, and most of the time this is ladies, where you had 9 years and 6 months, of work record. All you needed was 2 more quarters to qualify for at least the minimum benefit. So, I've offered to hire a few people to just get them their next 2 quarters. But, Starbucks pays health benefits for part-time workers. That might be an option. But there's a lot of places you could get those last 2 quarters, and you never know. You might enjoy that particular job. Yes?
So does that mean that when you continue to work past retirement and you're still putting money into your Social Security, that you could increase your monthly benefit now?
Yes. Yeah, you can increase it now. A lot of people do by continuing to work and paying into the system. If the current quarter is one of the highest, or the current year is one of the highest 35 years, it might kick out one of the lower years. So it could increase your benefit. Absolutely. You want to look at what your income needs are now and also in the future. You want to look at maybe your life expectancy, your spouse's life expectancy. So the surviving spouse will receive the highest of the two benefits. The lowest of the two benefits drops off. So if I crunch your numbers and I say, well, in your case, it might make sense. In fact, someone was in the office today that this was the case. It made sense for them long term because of their unique situation for him to go ahead and file as soon as he retired from his job. Even though it was not yet 70, it made sense for him to go ahead and file for his benefits. However, that doesn't consider the fact that if he waits till 70 and then he passes away, if he's the first to die, that the wife's survivor income will be a lot higher if he waits till 70. Okay. So 8% growth a year. So the math says file soon, but really, we talked about psychology earlier, really making the lifetime income for your spouse more secure by deferring as long as possible. So this next part is taxation of benefits. We're going pretty good pace here. So this was what I was saying on the tax side earlier. If you are before full retirement age and you're still working, your benefits are going to be reduced $1 for every $2 you earn over $21,240. Like you said earlier, it's adjusted and added back at full retirement age. So you don't want to let the earnings test discourage you from working. Just wait till your full retirement age or later to apply for benefits. For most people, if you're still working, you don't need benefits. So let them grow. Let them earn those. It's really called a reduced benefit if you file early. It's not a delayed credit. It's called a delayed credit from full retirement age to 70. So don't have a reduced benefit by filing early. Wait as long as you can.
Okay, you say, if you wait till 70, your spouse, when you die, gets a bigger cut.
If you're earning the
What if she starts earlier drawing her Social Security? Is there a marriage penalty? Or does she get your full amount?
She gets whatever amount you're receiving.
Okay.
Yeah. So the question that Roy asked was, if she filed earlier, is she going to have a reduction of benefit if he dies? The answer is no. When he dies, she gets his benefit if his is higher. The surviving spouse gets the higher. What you're thinking of is while both people are living. So the lower earning spouse will, if the benefit based on that spouse's work record is less than half, then that person's benefit will be boosted up to 50% of the higher earning spouse's benefit if the lower earning spouse waits to his or her full retirement age. That was a mouthful. So if the low earning spouse's benefit is less than half, he or she will receive 50%. It's called a spousal add-on. It'll be bumped up to half of the higher earning spouse's benefit if that low earning spouse waits till his or her full retirement age.
Does the higher earning spouse have to have already filed?
Yes, to receive a spousal benefit. However, if the higher earning spouse is delaying benefits, let's say they wait until 70, the low earning spouse does not get delayed credits. So there's no delayed credits for that low earning spouse to wait past their full retirement age for a spousal benefit. Only for benefit, you only get the delayed credits for growth of the benefit on your own work record. with the exception of early filing to full retirement age. One thing that Dr. Kotlikoff says about this is the Social Security system is probably the most complex physical system ever developed. So don't feel overwhelmed. I know it's overwhelming, but don't feel like a Lone Ranger because it's a lot to take in. And so we want to understand as much as we can, but then really looking at your situation very specifically in our software makes it pretty clear. You can Social Security has a lot of tools also. You can look at their website and they have some calculation tools that are pretty good. But again, they're not going to show COLA after 62. So we want to include that if possible. So we've talked about a reduction of benefit. There's also tax potential on your Social Security. Your Social Security is not taxable in and of itself, but it's taxable subject to other sources of income. And so it's going to be based on your modified adjusted gross income. So a lot of people know what adjusted gross income is. And so what modified adjusted is, it's just your adjusted gross. And the most common thing that's added back to that is tax-free income, such that you might be receiving from municipal bonds. And there's a few other things, educational benefits that get added back. But for most people, the municipal bond income is the main thing that gets added back in. You come up with MAGI. So they're going to take all of your modified adjusted gross income, and then they're going to take half of your Social Security. The sum of those two is what's called provisional income. And so these thresholds are based on provisional income. So if you're married filing jointly and your provisional income is under $32,000, your Social Security is not taxed. If it's between 32 and 44, half of your Social Security is taxed at your ordinary income tax rate. And if your provisional income is over 44, 85% of your Social Security is subject to income tax. That makes some people mad because they tell me, well, we had to pay a tax to even get the right for the retirement benefit. Yes, ma'am.
When you're saying amount of Social Security is subject to tax, if you have your regular gross income from work and you add your Social Security benefits,
Half of it.
that is half of it, the tax portion of the whole thing was up to 85%? Is that what you're saying? Or just your Social Security?
The reason you're confused is because of the calculations to determine the percent that's subject to tax.
Okay.
So there's two things: the calculation, and then the actual tax that's applied to your income. So the calculation takes half of your Social Security plus all of your MAGI, and then that's what these numbers are. Okay, I'm sorry.
So if
That's
it's
what
over
these numbers are.
40,000.
So then, let's say that your provisional fell within 32 to 44, then 50% of your Social Security income is going to be taxed. It's one of the reasons it's confusing because 50% is used twice, isn't it? It's used in calculating how much, and then it's used in the application of it. But if you're over 44, 85% of your Social Security income is subject to income tax at your ordinary tax bracket. Yes, sir.
Provisional income, if one spouse is getting Social Security and the other one continues to work, the working spouse's income is part of that provisional income, right?
Yes, married filing jointly.
If your Social Security benefits are over that, it's taxed? If it's just Social Security?
No.
Like if I had $64,000 between the two of us, if I had $64,000 worth of Social Security benefits, it would
No.
be taxable?
No.
But only if I made $1, it would be.
That's right. Yes, sir.
So I can figure out where we're trending. A Roth disbursement, would that apply to provisional income?
No, because it's not part of your income at all. So the question was, that David asked, is what about a Roth disbursement? Because David is doing something smart, he's building a Roth, maybe distributing, but he built one at some point. So Roth distributions are not income. They're not considered income, so they're not going to figure into your modified adjusted gross income.
So the traditional will.
Traditional distribution will, okay? Yes, ma'am.
About alimony.
Alimony, I believe, is taxable. Yeah. If it shows up on your tax return as income, then it figures in the calculator. And I'm pretty sure alimony does. Okay, great question. Okay, so you can reduce other income and tax advantage investments, but you can't reduce municipal bond. So there's things you can do, like on investments, to make some of that income be hidden. You can anticipate IRA R&Ds. That stands for required minimum distribution. So if you haven't made it to 73, they just changed the rule this year where at age 73, it was 70 and a half. Then they changed it to 72. Now this year it's 73, where you have to start taking distributions from your IRAs. And that's going to be income to you. Okay? So there's things you can do. And so you might want to convert to a Roth. So we have some different strategies for Roth conversions. You may want to delay your Social Security benefits. So another pretty decent reason to delay Social Security benefits could be the taxation of those benefits. And what if we could implement some strategies before you file that would reduce your provisional income, where when you do file, you won't be subject to as much tax. So that's a very common thing that families, that we have families do. You can reduce your expenses so you don't have to take as much out of your accounts, specifically your qualified accounts. And then you want to continue to review and manage taxes throughout retirement. I'm going to kind of go off on a real quick rabbit trail because I think it's very important as it relates to income planning. And, we're talking about Social Security. That's a major component of income planning. And so I want you to think about your qualified accounts. And we're going to take a break in just a minute. I'm moving pretty quickly, so I don't think we're going to be here for 2 hours. We'll be done quicker than that. But think about your qualified accounts, and that's a fancy term. All that means is investment accounts that you have not yet paid taxes on. So that could be an IRA, traditional IRA. It could be a simplified employee pension if you were self-employed. We have a lot of doctors that have their own doctor groups that do SEPs, simplified employee pensions. It could be a simple IRA. It could be a 401k. It could be a 403b, 401a, 457. So all of those are qualified plans that have not yet been taxed. So really, if they haven't been taxed, there's what? A tax lien on those accounts. There's a lien. So you might have $1 million 401k, but it ain't all yours. And so what are we doing with these accounts? I want you to think about what we're doing. What's our goal with these accounts? To grow them, right? Make them bigger. We want to make these accounts bigger. And so if we're growing an account that's taxable, what are we also growing?
Tax bill.
The taxes, right? And so if what our plan is now may be to grow an account that's taxable, and so our plan really is to also grow the future tax. Now, what rate are you going to pay tax on? What rate of tax are you going to pay on that future higher account balance?
Current rate.
No.
Higher rate.
No, you're not going to pay the current rate. So unfortunately, go ahead.
Yeah, maybe.
That's right. So unfortunately, we don't get to pay the rate that we were in when we contributed. And we don't get
the current rate for when you start withdrawing.
Okay, gotcha. You had it in your head, it just came out different. And we don't get to pay the rate that we are in now. So just a poll of the room real quick. How many believe we're going to be in a lower tax bracket later? How many believe, instead of us personally, how many believe in general tax rates are going to be lower later? No one raised their hand. So you're saying you believe taxes are going up, and I'll just say this, I think this generation could be the first generation in history where our tax brackets in retirement are higher than they were during our working years. Why is that true? Deficits.
Fewer people paying in to more people who are getting out.
You got it. So our national debt, over $31 trillion, the highest in history, the first time in history, it's greater than our gross domestic product. It's sickening. On some of these workshops, I just picked up the national debt calculator. It's constantly growing. Have y'all ever seen that? Yeah. It makes you sick looking at it. But who is the source of our government's revenue?
We are taxpayers.
There's so much pressure on Congress. Every time in history when we've been in this situation where our highest marginal bracket was where it is now, and by the way, it's at a historic low, and our national debt was high due to whatever reason, oil embargoes, world wars, Great Depression, they've always raised taxes because they're trying to squeeze that debt down, so they have to they're trying to bring those together. So the space between those two right now is higher than it's ever been. So that's why we talk about red zone. We're in a red zone. It's a perfect storm. And the message I'm trying to get across today is not all doom and gloom. The message is planning. Let's plan. You've taken a step. You're here right now to learn. And so that's a very important first step. Hopefully it's a motivation to come in and look at how what we're talking about applies to you real specifically. Let's crunch the numbers.
So invest in your 401k pre-tax. Pay your tax now in your 401k.
That may be a strategy. That may be something to do, yeah. So if you apply early, your benefit starts lower and stays lower for life on your Social Security. COLAs will magnify the impact of early or delayed filing. In other words, if you delayed your filing and the benefit's higher, the percent of COLA is going to be applied to a higher amount. So it's magnified. Your benefit can be taxed and reduced to cover your Medicare premiums. You don't want earnings tests to discourage you, and delaying benefits may give surviving spouse more income. All right, so we're going to cover spousal benefits. I think now is a good time to take a break. The next section is really cool because we get into some case studies and actual scenarios. For me, I learn better when I'm actually looking at a situation. So we'll cover that after the break. Melissa will go around if you're ready to find a time on our calendar. Most of our calendar is spent having client review meetings. So we do regular client review meetings. After these events, we do set aside some time over the next couple of weeks to address anyone that wants to have a meeting. So if you want to come in and have a personal strategy session, there's no cost to that. There's no cost to you, at least. We cover, the time that we spend. We don't charge you for that. And then there's no obligation. The goal for these one-on-ones is to see, number one, can we answer the question that you have? What questions can we answer? And then number two, does it make sense to have a second meeting? Does it make sense to continue to engage to see if we might be a good fit one to another? So that's the only two goals. What questions can we answer? And then it may be the only meeting we have. If we're not a good fit, then we don't need to have a second meeting. But we'll take about a 5-minute break, refresh your drink or snacks, and then Melissa will be going around.